Well, it's confirmed. The Fed's minutes have been released. Taper talk has now turned to taper action. The Fed will begin tapering its asset purchases somewhere between mid-November and mid-December. So we're a month out from the earliest date in which taper can begin. And again, this is not the Fed selling assets. This is not the Fed letting their balance sheet run off. This is the Fed saying, we're going to stop doing so much QE. Currently, the Fed's doing $120 billion a month. $80 billion of that are treasuries. $40 billion of that are mortgage-backed securities. And they're planning on tapering somewhere in the neighborhood of $5 to $10 billion every month. So at the fastest pace, that means that if they start in mid-November and they taper at a rate of $10 billion, QE will be over, and I'm chuckling already, by November of 2022. Now, I chuckle because I don't think that the Fed will be able to actually totally taper, which is kind of funny how far we've moved the goalposts. A couple years ago, those of us who were big Fed critics were saying, oh, the Fed's never going to be able to normalize their balance sheet. They're never going to be able to unwind their balance sheet because tapering was already done. There was no QE going on. QE was a thing of the past. It was an old emergency measure that was never going to be resurrected, and it was just a matter of the Fed letting their balance sheet run off and getting rid of all of these assets that they had accumulated during the previous rounds of quantitative easing. But now our ever so fragile economy, which is built on a foundation of financialization, is so weak that not only does it take $120 billion in QE to sustain whatever it is, whatever kind of prosperity we can be said to have right now, I would argue that bad things are going to happen long before the Fed is able to totally taper. So QE will never end. QE is going to increase. Now, does that mean that it's a good thing? Does QE help the economy? No. Honestly, I'm not exactly sure what QE does. I'm convinced at this point that the effects of QE, to the extent that they have any sort of positive effects for the economy, are entirely psychological. But to that effect, if the effects of QE are psychological and the Fed begins tapering at a rate of $10 billion a month, that's going to have the inverse effect, meaning that it's going to have a negative psychological impact on market participants. Now, so far, that's not the case. Yields are down today, but then again, gold also seems to be rallying. It's kind of strange. You're seeing bonds and metal move in the same direction. The CPI number came out today. Year over year, the consumer price index hit 5.4%, which is just laughably low when you look at prices in the real economy. And if you understand how the consumer price index is calculated, it's designed to be low, but still 5% inflation, over 5.5% inflation actually, is huge by the standards of the last 10 to 15 years. And will the Fed's tapering really have an effect on inflation? I wouldn't think so, because QE itself is not really inflationary. As I've argued before, or I shouldn't say, it's not really my argument. I'm not confident enough in it to argue it myself. But as I've gone over before, there are people who argue that QE is actually deflationary because, in a way, in the financial economy, U.S. Treasuries serve as a form of base money. And those treasuries are rehypothecated so many times they are used to expand the money supply. And so when the Fed buys up treasuries through quantitative easing and throws them on their balance sheet, they just sort of sit on them, and they don't use them to increase the money supply. And you could say, well, the Fed is putting all, is buying these treasuries from financial institutions and increasing their reserves. And so these institutions then can lend out more money because they have more reserves on their balance sheet. And, you can get inflation that way. And that's not really the case because excess reserves have been off the charts since the financial crisis. The banks are flush with reserves. They don't need more reserves. And so the net effect is that the Fed is taking those treasuries out of circulation and not replacing them with anything. And so by tapering, the Fed is actually going to enable more financial expansion, which is a nice way of saying that stocks might actually go up. Now, is this going to affect anything in the real economy? No. I don't think that the Fed's tapering is really going to have much of an effect on the real economy. I don't think that it is probably not going to affect mortgage rates. But, the answer to that question really depends on how you rate the Fed's role in the Treasury market. Is the Fed really stepping in and propping up a bunch of demand for treasuries that isn't actually there? In other words, how much is the Fed distorting the Treasury market? That I don't know. That's something that we're going to find out as the taper unfolds. Interestingly, bond yields have been rising in recent sessions. I don't know if it's gone on maybe a week, 2 weeks. But today, with the news of the Fed minutes talking about specific dates in which they're thinking, when they think the taper is going to begin, we did not see yields spike. They dropped. Now, when it comes to mortgage-backed securities, I feel much more confident in saying that I think the Fed is playing a much more of an outsized role, even though they're only buying $40 billion in mortgage-backed securities versus $80 billion in treasuries every month. And the reason for that is that, unlike treasuries, mortgage-backed securities are not considered to be pristine collateral, and so they're not really being used by institutions to go out and borrow against them to try and go out and buy more risk assets. Now, they can use mortgage-backed securities, but it's not considered as good of a type of collateral. And so you have the mortgage-backed security market is much more pure in the sense that people who are buying mortgage-backed securities actually want to own them. They're not just using them in some sort of financial engineering scheme. And if you think about what a mortgage-backed security is, it's a financial instrument that lets you own mortgages. And so the Fed, by buying $40 billion a month in that, they are dumping $40 billion into the mortgage market. They are essentially providing $40 billion in funds to be lent out every month, guaranteed it's going to sell. And so the Fed is incentivizing the sale of houses and thus, inflation of housing prices. And so I'd be much more willing to say that you're going to see a hit to the already faltering housing market as a result of the Fed's tapering of the purchases of mortgage-backed securities than I would say that you're going to see a big hit to the Treasury market as a result of the Fed's tapering. Because Treasury is an asset that you can use not just to collect the measly interest that you get, the 1.5% or so that you get from a 30-year Treasury, or gosh, what's a 10-year yielding right now? I can't remember. But if you have on the run 10-year Treasuries, you can take those, go into the repo market, borrow against them, and then go buy something that actually is going to yield a lot of money, like stocks or some sort of high yield toxic waste. But funding markets are very opaque and they're very confusing, which is why most people don't just completely ignore them. I would like to do that. My job of trying to analyze these things, of course, I'm just an amateur. I do this for fun. My job of doing this was a lot easier before I knew anything about funding markets. It took me, a few years to where I really understood them at all, to even know, what the heck I was looking at. But now that I know it exists, I can't ignore it. I know it's extremely important. It's one of the most important pieces to this whole puzzle, and so I have to consider it constantly. But considering that we don't know a lot about them, and they're a very important piece, there's a whole heck of a lot of unknown in this equation. Now, one more thing I'll add. It's not impossible that the pace of QE is accelerated, because I think the Fed, looking at what's going on right now with the CPI printing as high as it is, 5.5%, versus it was expected to be 5.3%. Either way, even if it was a couple, tenths of a percentage point below expectations, CPI over 5%. That's not something you want to just let lie. And Powell's made it clear, hey, what kind of schmucks would we look like if we were raising interest rates while at the same time doing QE? So they have to taper in the eyes of the Fed. They have to taper before they could ever, look at raising interest rates, which is really what you have to do when inflation is a problem, because low interest rates is actually putting real money into the economy. QE isn't. QE is just putting money into financial markets and, arguably starving financial markets of collateral that they require to actually inflate themselves. So maybe in some ways QE is restricting the inflation of equity markets. But either way, I think the Fed is looking at this and saying, hey, we got to get QE done before we can even thinking about being able to use interest rates as a tool to rein in inflation. Because what did old Paul Volcker do after the 1970s, when we had years and years of pretty high inflation? He raised interest rates up to like 20% or 25%, something ridiculously high, and that snapped inflation back into shape. Now, there's no one alive at the Fed today who would ever consider something like that. There are no Paul Volckers in modern America who would ever make it to the role of being anywhere near the levers of power of a central bank. But, even to raise rates a little bit, they know, hey, even if we raise rates from 0% to 1%, which would be huge. I mean, that would be four hikes that the Fed would do, maybe in a quarter. So we have a whole year's worth of hikes, which wouldn't make a difference. If inflation's over 5% and you raise interest rates from 0% to 1%, you're not fixing the problem. When Volcker fixed inflation, he had to raise interest rates significantly higher than the rate of inflation. And what does that do? Just for those of you who, who might not be hip to monetary history, what was the point of that? Why did Volcker do that? Well, it got people to stop spending money. It got people to stop bidding up the prices of everything, because everyone was looking at it saying, gee, there's 10% inflation. If I sit on this money for a year, I lose 10% of the value. So I got to go out and buy everything I can, spend every penny that I have, and get it in something real, in real goods, or else I'm not going to be able to afford them a year from now. And so inflation, becomes then it's a snowball rolling down a hill. It keeps getting bigger and bigger. And so what Volcker did was he raised interest rates so high to where it incentivized people to sit on that money. Because if they sat on that money and they earned 20% on it, let's say, well, even if inflation is 10%, they are making that extra 10%. They're making 10% above inflation. And so it's worth it to them to sit on their money. And so when all of a sudden you have people not spending every single dime that they take in the economy, you sop up a lot of that excess money. The Fed can then take that money and throw it in an incinerator, figuratively speaking. They get the supply of money down, or at least they stop increasing the supply of money so quickly. Then all of a sudden inflation is gone. Powell would never do that. Janet Yellen would have never done that. Ben Bernanke would have never done that. Alan Greenspan had the sense to do that, but I think that he had the political prowess to know that to never do that. But I think Alan Greenspan probably wouldn't have gotten himself into this position to begin with. He was too smart for that. The problem with Alan Greenspan is that all of his successors, who modeled themselves after his own image, if you notice, every central banker that we have here in the United States, they govern much more like Alan Greenspan and not at all like Paul Volcker. Well, why is that? Because Paul Volcker is remembered as that grumpy old man with a puffing a bunch of cigar smoke, testifying before Congress on the cover of Time magazine, that curmudgeon who ruined the party. Whereas Alan Greenspan is remembered as the maestro who defeated the business cycle. The problem is with people like Powell and Yellen and Bernanke is they copied Alan Greenspan's playbook without understanding the logic and the philosophy behind his plays. Greenspan was a Machiavellian. He didn't make what I would consider to be good decisions, but they were rooted in logic. He was a smart person. He understood the way that the monetary system worked, and he made the decisions which were most politically expedient for him. Powell, likewise, is trying to make the most politically expedient decisions, but he doesn't understand the way the monetary system works. Powell is an attorney. And that's not to say that nobody who's not, educated in economics can't have an opinion on the economy. That's not what I'm saying. But I'm saying he does not have the mind for economics. He has really no solid foundation in it. Alan Greenspan had a long history of talking about the economy and economics before he got to the. So what I mean to say here is that no matter what happens in the next few months regarding inflation and the economy, it's going to be a total accident. Jay Powell does not know. He might think he knows, but he doesn't know what the results of his actions will be. And I don't either. I have to think more about this because things have just gotten so ridiculous that I've become tired. It's really hard to follow this stuff with all the other insanity going on in the world. The monetary insanity is just a little too much for me. So, with that said, I will see you folks back here tomorrow.